All right. Apologies for the short break. I had to reset my system. It was messing up. Apologies for that. So please, if you can quickly hear me, just give me a thumbs up as we continue tonight. Mm, Thank you so much. So in our last class, we started with consolidation of financial statement, and that talks about the group account, and that is dealt with under IS 27, IFRS 10, IFRS 3, and then with a good considerations into IFRS 13, that is a fair value measurement. We've been able to look at the overviews and the definition of terms, as it were, and then we are currently on how exactly should you, be able to do, the consolidation of the financial statement. In the last class, I was able to establish the fact that when we're talking about consolidation of financial statement, we are simply saying that you merging two or more financial statements together, and usually between the parents and the subsidiary. That is what we call consolidation. And so the parent we have been able to establish is the one that has the highest control over the other entity known as the subsidiary. So merging the account together is what we know as a consolidation of financial statement. Please, you can do well to watch the previous two videos that we have on this on our YouTube channel, and I believe that will help us, a lot. So quickly, let's move forward. I told us the last class when we are consolidating financial statement, two steps are all that you need. For those that are just joining us, please listen very carefully. You need basically two steps. The first step is what I call open the skeleton. Open the skeleton, that is, write out the headings, the currency under consideration, as well as the rounding of denomination. That is the first part under the opening of the skeleton. And then the second part of you opening the skeleton is when you combine all the items in the financial statement that you are combining. You combine them together, and that, like for instance, what I'm trying to say is this: if you are consolidating of financial statement, as it were, you are going to have the asset of the parent plus the asset of the subsidiary. You combine it. That's that for that. And then you leave an open space. What I mean is this: for instance, if you are combining asset of parent with that of subsidiary, let's assume PPE, for instance. You have PPE there, you have investment property, intangible assets, and the likes. If you are adding PPE of parent to that of the subsidiary, you add it together. And then any other adjustment that you need to make, what you just do is you just open bracket. If, for instance, they say parents has 50 naira as a PPE asset, subsidiary has 20 naira as a PPE asset, you will just write 50 plus 20, and inside the bracket, you open the bracket down, you will not close it in case there are other workings. And that's what we call you combine all the items in the assets, in the liabilities, both in the entity statement of financial position, but you are not to combine the items that are within the equity portion of the statement of financial position. What I'm saying is this: you combine asset to asset, liability to liability, but under this equity section in the statement of financial position, you are not to combine all those items under the equity section. Rather, you are only going to write down that of the parent alone. When we are doing example, I believe you will see it better up. So these are the first thing, the two things you have to do under the step one. I said you will open up the skeleton. Now, the truth is this: if you're able to do this thing, I said it the other class, humorously, some people were laughing, they thought that I'm just playing with it. But the truth is this: if you're able to open the skeleton, and if you're unable to do anything at all, if you're able to successfully open the skeleton, the fact is this: there is no way you won't get up to 3 or 4 marks with only opening the skeleton and not doing anything else. That's why I always advise my students, once you get to exam hall, if you see a group account and you are going to attempt it, always open down the skeleton. How do you do that? Write the headings. If it's a Molente group account, you also write it Molente group account as that the first is 124, like that. Then you go, you leave a space, you write your currency. If it's naira, you put it naira. Rather not figure. If it's 0030, you put 030. If it's to millions, you put it to millions. Then you go down. If it's not financial position that they are asked you to combine. So let's begin from there first. If it's not financial position that they ask you to consolidate, the first thing you do is you go and open the skeleton there. You go and write down asset. Under asset, you write all the items of asset that are under asset. The non-current asset, the current asset. You add them together, but you inside the bracket, but you will not close the bracket in case there are other workings that are coming in. When we look at an example, I'm sure you will get it better. I'm just trying to do an overview and from that. So that is that for that. That is step 1 there. Step 2, I said you are going to do the following 7 workings. That is step 2. Do the following 7 workings. Very, very important. Step 1, I said open the skeleton. How do you open the skeleton? I have explained. Now we are in step 2. You do the following 7 workings. Quickly, let me list those 7 workings. Number 1 is that you are going to determine the number of years that you have to consider when you are doing your consolidation. You determine the number of years. That is number 1. Number 2, you determine the group structures. As we go on in this lecture, I will be showing you all those things how to do it. Number 2, you determine the group structure. Number 3, you determine the fair value of the net asset of the non-controlling interest, that is the subsidiary. The non-controlling interest in the subsidiary, you determine the fair value of the net asset. That's number 3. Number 4, you determine goodwill. That's number 4. Number 5, you will determine non-controlling interest. Very, very important. You determine the non-controlling interest. And number 6, you determine the group reserve. And number 7 workings are other workings. So those are the 7 workings that you are expected to do. So once you have a group account to do, if you follow these steps, there is no way you will miss out. There is no way you will miss it. So please, I want you to watch the first 2 videos and then get acquainted with whatever it is that we have discussed. You have been able to look at the workings 1, workings 2, and workings 3 in our previous video. So today we mirror down to the workings 4, 5 to 7. I'm sure you understand that. That is that for that. So please, let's go to the workings 4. And that is determining of the goodwill under consolidation of financial statement. However, before we move further, I think it's better that I ask, do you have any question so far? Any question at all? Are we good to go? Can you hear me, please? Okay. So determination of goodwill. Under the determination of goodwill, you have 2 methods that you can use. We have the full or fair value goodwill method, and then we have the proportionate method. We have the full or fair value goodwill method, and then we have the proportionate method. Under the fair value or the full goodwill method, how you evaluate your goodwill is by measuring the differences between, the 100% of the net asset of the subsidiary from the purchase consideration. And this can only be achieved when you have been able to adjust for, any increase in fair value that is recognized in other reserve and fair value of non-controlling interest. Look, just use this format that I put down here. Purchase consideration. That is the first thing first. And what is purchase consideration? Purchase consideration simply means the amount that the parent paid for them to, buy the subsidiary or to have a stake in the subsidiary, as it were. The amount that was paid. Usually, you will see it in your question that so person acquire 80%, and the other person for the sum of 200,000 naira. That 200,000 naira is known as purchase consideration. It's known as a purchase consideration. So when you have a purchase consideration, the next thing you will have to hit is the fair value of the non-controlling interest. That is the fair value of asset that you determine in workings 3. That is why you have to do them in a sequence. The fair value of asset that you determine under workings 3 is what you will add to the purchase consideration. That's why they call it full or fair value goodwill method. Under this method, you see, you have what we call the purchase consideration. And then you have what we call what you determine in workings 3, known as the fair value of the net asset of the NCI at acquisition and at consolidation. So the one you are going to carry is the fair value of the NCI at acquisition. You add it up to the purchase consideration, and then you less any increase in fair value that is recognized in the group reserve. Usually, when there are any fair value increase in the group reserve, what you do is you to less it. For instance, if there are other items, that they have fair value increase, other items like let's say investment property, for instance, you understand that was not considered when you are determining the NCI, but you are recognizing you are recognizing the group reserve, you less it from this portion. You will see it when we do examples. And then the next thing you are going to less is the net 100% of the net asset at acquisition. You are going to less it from this from what you have been able to get, and then you less impairment, and that will give you your carrying goodwill. Let me go over it again for understanding. The fair value or the full goodwill method is a method that evaluates goodwill using, the 100% of the net asset of subsidiary. You less it from the purchase consideration, that is the amount that is invested by the parent, after you have been able to make the adjustment for increase in fair value that is recognized in other reserve, as well as fair value of the non-controlling interest. So it is calculated as follows: purchase consideration plus the fair value of the NCI minus increase in value recognized in group reserve, minus 100% of the net asset at acquisition. Now let me explain this again for clarity purpose. Under this full goodwill method, you have what we call the fair value of the NCI. The fair value of the NCI means the percentage that the parent do not have control over. That portion that the parent do not have control over is known as the non-controlling interest. So that the fair value of that non-controlling interest is what you are going to add to the purchase consideration, and then you less the net asset of the subsidiary at acquisition from it to give you your goodwill. And then if there is any impairment, you less the impairment to have what we call the carrying goodwill. Now, let's go to the proportionate before we take an example. So I will just explain it, then we'll go there. The proportionate rather or partial goodwill method. This one evaluates the goodwill by measuring the difference between the parent portion of the net asset from the purchase consideration. It is calculated as follows. First of all, you put down your purchase consideration, and if there is any fair value that is recognized in the group reserve, you less it from the purchase consideration. You now less parent portion of the net asset at acquisition. So now the differences between these two is this. If you check the full goodwill method, you have purchase consideration plus fair value of NCI, that is the one that parent do not have control over, you add the two together, and then you now less the total assets of the subsidiary at acquisition from it. That is for the full goodwill method. But for the proportionate method now, ordinarily, what if there are no adjustment of fair value, in the group reserve? What you just do is you have your purchase consideration. You will now less parent portion of the net asset at acquisition. In other words, if, for instance, we have been able to calculate our net asset at acquisition to be 200, let's assume that the parent acquire 80% in the subsidiary. The net asset that you are going to carry under the proportionate or partial goodwill method is that of the parent. You 80% of the total amount of the net asset of the subsidiary. That is what you are going to less from the purchase consideration to get your goodwill. And if there is any impairment or loss, you less it and to get your carrying goodwill. It's as simple as that. Then let's look at the workings file. I want to explain, then we'll take an example, then we'll do all the workings together by ourselves. I hope that is clear enough. Are we still together? Are we still together? So please, what we do is this. The timing on this one is exhausted already. Let's just go to our WhatsApp platform. I'll send a link there. Let's quickly migrate into that. Then we'll do the NCI and do the workings, and we shut down. Please, let's quickly shut this one down, and then we move to the next one. Thank you so much. Okay, so we continue from where we stopped. We determine the NCI. I'm sure you now have understanding of how to determine the goodwill. Like I said, two methods can be utilized: the full or the partial goodwill method. Either you use the full, that is, you will be told in any question they are given to you if you are writing your exam, you will be told which method you are to use. If it's full goodwill, it's very, very simple. You just add your purchase consideration, the fair value of the NCI, that is the NCI, the portion that the parent do not control. The portion that the parent do not control is known as non-controlling interest. That's why the name NCI, non-controlling interest. So the fair value of that NCI is what you will add to the purchase consideration. You now less the total asset at date of acquisition from that total amount to give you your goodwill. If there is any impairment, you less that impairment from that, and that will give what we call the carrying goodwill. That is the one you carry forward. That is for the full goodwill method. And if it's for the proportionate goodwill method, the proportionate is also known as the partial goodwill. Either ways, whatever then they call it, just know that once you hear proportionate or partial, what you need to just have at the back of your mind is purchase consideration minus the parent portion of the net asset at acquisition. That is what we are going to less from the purchase consideration to have what we call your goodwill. And then when you less impairment from it, if there are any impairment, you have what we call the carrying goodwill. When we also look at another example, I'm sure you have a better understanding. So that is that for that. Then the next workings you have to determine out of the 7 workings is that of the NCI, that is the non-controlling interest. Now, like I said, if you are using, let me go back to that goodwill again. If you are using the full goodwill method, the simple implication is that if there is any impairment, both the parent and the subsidiary, they are going to bear that impairment according to the percentage of their controls. What I'm saying is this: under the full goodwill, the full or the fair value goodwill method, if there is any impairment, the impairment will be shared between the parent and the subsidiary based on their controlling powers. If, for instance, the parent has 80% control, the 80% of the impairment will go to the parent, whereas the 20% of the impairment will go to the subsidiary. But if it's under proportionate or under partial goodwill method, if there is any impairment or any loss as it were, only the parent bears the full impairment. The subsidiary will not share from it. Are we together? If you can hear me, please just give me a thumbs up. Thank you so much. That is that for that. So also when we are looking at the NCI, when we are to determine the non-controlling interest, under the proportionate method, the non-controlling interest in the subsidiary portion is the subsidiary portion of the NCI asset at that reporting date or the date you are consolidating. In other words, when you are to determine the non-controlling interest, once they say you are to determine your goodwill, or they say company policy is to determine goodwill using proportionate method or using the partial method, just know that if you are to determine your goodwill, you are going to less from the purchase consideration parents controls, that is the parents portion of the total asset at acquisition. That's what you are going to less from the purchase consideration. Now this will give us goodwill as it were, and then if there is any impairment, we less the impairment from there and to what we call the current goodwill. Now also when you are to determine your NCI, as long as they say the policy of the company is to use proportionate method, to determine NCI is very direct and straightforward. How do you do that? You are just going to look for the non-controlling interest, that is the control, the ones that the parent do not have control over. Take for instance, if they say the parent acquire 80%, it means that they are not in control of 20%. So the NCI is the 20% of the total asset at the reporting date. The day of reporting is the day of consolidation. The day you are consolidating is the reporting date. So the value of the NCI at the date of consolidation is the non-controlling, that is the portion that the parent is not controlling. The portion that the parent is not controlling. Please take note of that. Very, very important. Take note of that, so that you will not. Apologies, please. So that is that for that. Then the other one is the group reserve. That is the working six. Group reserve. Under this group reserve, just do it the way I'm showing you now. That's how you should do it. Okay, please, before we go to the group reserve, let's go back to the NCI. I've been able to explain out of the proportionate. Now let me explain out of the full or fair value method. Under the full or the fair value method, just use this format. To determine the NCI, just check what is the non-controlling interest portion of post-acquisition gain. That is to say, like I was explaining earlier, once they say you should use the full goodwill method, once they say it is the policy of the company to determine their goodwill using a full or fair value model, just know that if there is any gain, how will gain come? How will you determine gain? It is when you are doing when you are doing working steering. That is usually where you are going to determine whether there is gain, or there used to be gain, and if there is loss, it's not about over the years. I've not seen anywhere where loss occur. Now, how do you determine the gain under that net asset? The net asset that you are determining in working steering, we have what we call the net asset at acquisition, and we have net asset at consolidation or at a reporting date. Now, the two total, at the end of the day, used to be different. The two total are always different. And usually, acquisition dates are always lesser to the reporting date. So the difference between the acquisition date and the reporting date is always a gain. Once the reporting date is higher than the acquisition date, that gain under the full or fair value model, both the parent and the subsidiary are going to divide that gain in their respective holding or controls. Equally, if there are losses, they are also going to share it under if the policy is to determine goodwill using a full or fair value model. But if it is proportionate or partial value model that they are using, only parent is going to be the one to take the gain. And if there is any loss, parent only take the loss. Any question, please? Any question? I want your questions, please. I want reactions and questions.
Hello, sir.
Please go ahead.
Yes. But in a situation that, in a question, the fair value amount was given directly, how are we going to treat that one?
Come again, please.
There are some questions that fair value amount, will be given directly.
Yes.
And how are we going to treat that one? Are we still going to calculate fair value for the NCI, or we are picking that figure directly?
You are taking that figure directly.
Okay.
Now, let me explain that also to you. Thank you because you brought that question. Thank you for that question. Now, you see, whenever they give you the fair value, the net asset fair value of that company, what they are simply telling you is that that must be what you must get. That must be the value that you must get at the end of your calculation. Now, if you have been able to determine, if you are able to determine the share plus the assets as it were, and then what you get is not up to that amount. It's not up to that amount. That is what we now refer to as a fair value increase. Do you understand what I just explained?
Not well understood.
Let me come again. Once they give you that fair value in that question, or in your question as it were, understand that that is the total that they want you to actually get. So that is in working theory now. Let me take you back to working theory so that you have a better understanding of what I'm trying to say. Look at it. Working theory is that it will determine the fair value of the net assets of subsidiary at date of acquisition and date of consolidation. This working theory is what you must always do. Now, this is the simple way to do it. You have your share capital, whatever, the one you are bringing here are for the subsidiary alone. When you bring it here, your share capital at acquisition, they don't change. It's the same thing. What you have at acquisition is what you have at consolidation or at reporting date. You now come to the reserves. Also, under the reserves, the share premium don't change. What you have as share premium at acquisition is usually what you will have at a consolidation or at a reporting date. Now, you also under this reserve also, we have retained earnings. You have retained earnings under this reserve. This retained earning is what will always change. Retained earning at acquisition and at consolidation is always different. Why? Because we believe you have been in business, you are not supposed to be making loss. So it's either it is higher or it is lower. Then you also have revaluation surplus on usually on PPE. Revaluation surplus usually comes from PPE. Now, when there are also revaluation surplus, that will also come under your reporting date, your consolidation date, or your if it's at acquisition, you are going to note it, and then it's the same thing you have at acquisition is all we have on consolidation. But if they say it is a consolidation date, you put it under consolidation date. Now, when you total the share capital plus share premium plus retained earning plus revaluation surplus, you are supposed to have a total at the end of the day. If, for instance, in that question, they give you the fair value of the net asset of the subsidiary, once they give you that amount, that is what they said that you arrive at. Now, if you do not arrive at that figure, when you total your share capital, your share premium, retained earning, and revaluation surplus, and you don't arrive at that amount, that difference is there. That difference portion is what we know as a fair value increase. Is that taken now?
Yes, yes.
Any other question, please? I want you to ask question before we proceed. Let me be sure you understand what we are saying. Go ahead, ask question, please. I need questions. If you do not ask me questions, we are not going to move ahead tonight to ask questions. Ask questions. James Bola, ask questions. Are you there at all? Temidayo, please ask questions. Is it that all of us will understand what we have been saying so far? Hello, are we still together?
So we are together. Maybe as time goes on, question will come.
We can hear you. We can hear you. Let's continue, sir.
Okay, let's continue then. So that is that for that. Now, let's go back to our NCI. So under the NCI also, if you are to use the fair value or the full goodwill method, like I said, I think I extend that one. I've explained over and again. Under the proportionate method, NCI is very simple. NCI is NCI, the non-controlling interest portion of the net asset at reporting date. Net asset of the subsidiary at reporting date. That is as simple as it is. Whereas under the full goodwill method, you are also going to determine the NCI, that is the non-controlling interest at acquisition. That is, what is the portion of the total net asset of the subsidiary at the date of acquisition. For instance, if we calculate the share, what is it called? The share capital plus the share premium plus the retained earning plus revaluation surplus, and all this total give us 200 as it were. And they said that parent has 80% control in the subsidiary. The NCI is the 20% of the 200. Is that taken? 20% of the 200 becomes your non-controlling interest. That is the one that the parent do not have control over. Then, if there is anything like, post-acquisition gain, that is, acquisition minus consolidation will give you either a gain or a loss. If there is a gain, you add the gain to the NCI at acquisition. If there is any impairment, you less it from the NCI, and that will give you your NCI as simple as it is. And then you have the last one, or second or the last is what? Determining the group reserve. Determining the group reserve. This is one of the reasons why I said when you are, opening the bracket, opening the skeleton, you are not going to carry all the items under the equity. Why? Because there will always be adjustment to usually share premium and retain earning. And that's why I always say that if you are opening the skeleton, the only item you are permitted to carry directly under equity is the parent share capital. Only that one. But all of that one, you have to leave it. Because what will come under the equity are two things: the group reserve and the NCI. That is, your workings 5 will go under equity, as well as your working 6 will go under equity. That's why you always have group reserve, NCI, and then group reserve coming after the share capital under consolidation. It's as simple as this. And when you are determining your group reserve, just use this format that I have in point here. As simple as it is. But the first thing you will put down is that you recognize is the parent retained earning, the 100% of the parent's retained earning. That is the first one you will carry. Then, if you are using full goodwill method, you are going to add parent portion of the post-acquisition gain. And if you are using proportionate method, you are going to add all the gain, all the post-acquisition gain, because it belongs to the parent. Let me come again. The first thing first you will put down is the parent's retained earning, 100% of it. The next thing you will have to eat is if there is gain on acquisition. Now this gain, if you are using fair value or full goodwill method, if the policy of the company is to determine their goodwill using fair value or full goodwill method, it is only the parent portion, the parent controlling portion, that is the percentage that the parent controls, that you are going to take away from the total gain that was made and add to the retained earning. But if it is the proportionate method that we are using, or that you are using as it were, you are going to carry the total gain and add it up to the parent's retained earning. Number 3 thing that you are going to do is to less, if there is deferred consideration finance cost, you are going to less it. What is this deferred consideration? Now, if a parent is to acquire a subsidiary, there are 3 kinds of consideration, that is 3 kinds of payment that are allowed. The first one is by cash. Please take note of this. You can be asked to write short notes or to tell us what are the various types of purchase consideration. We have 3 main types. The first one is the cash consideration. The second one is the deferred consideration. And the third one is the share for share consideration. So please, what we do now is we are going to stop. Okay, let me just quickly add this. Then you have parent share of goodwill. If there is any impairment loss, you have parent share of goodwill impairment loss, and then unrealized profit on inventory, and that is that for that. And then working 7 is any other adjustment. It's as simple as this. It's very simple as this. That is the 7 workings and under step 2. So in the next video, we are going to look at the examples, and I believe that will help us to have a very good understanding. Thank you so much for your time again. So let's quickly look at this example now. The first example under the group account we are going to look at. This is a group of companies, as it were. They say Akpaba, listen please, I will read quickly. Akpaba Limited acquired 80% of Natashank Limited on 1st January 2021 when its net assets and retained earnings were 200M and 300M respectively. The fair value of the 20% NCI was 12,500. The state of financial position of A and N as of 31st December 2024 were as follows. Look at it now. You have current liability, you have non-current asset, equity, share capital, like that. Prepare a consolidated statement of financial position. If the group measure its goodwill using proportional and fair value method. So we are asked to determine the consolidated statement of financial position if the group measure its goodwill using proportionate and then the fair value model. The fair value model. So I told you, once you see a question like this, what is the first thing that you have to do? What are the 2 steps, please? Are we still together? Hello, are we still together? Are we still together, please?
Yes, we are together.
Open the skeleton, sir. Then we do the next working. We open the skeleton.
We open the skeleton, and then the second steps,
We do the next 7 working.
we'll do the next
The
7
number of
working.
years you know to consider, yes, the next 7 workings.
Thank you. So quickly, let's do it together tonight. I said the first step is you open the skeleton. What is the name of this company?
Akpaba Limited.
Akpaba Limited. Consolidation. Please, are we still together?
Yes.
Yes, sir.
So we are now opening the skeleton. That's what we are doing. So when I say opening the skeleton, this is what I ask you to do. I'm asking you to do too much. And I said the next thing you do, open the skeleton. This is how to open skeleton. You write the name. Whatever currency they give you is what you will use. What is the rounding off figure? The rounding off figure is N and 30. That is the same thing you should use. That is that for that. Then you bring this one here. You may need to put notes here so that you can easily demarcate. Then I said the first after this is the step 1 under. I mean the first thing to do under step 1, opening of the skeleton. I said you will write down the name of the company. Is that not so? The currency, and then the rounding of figure. We have done that. And I said the second one, you begin to combine asset to asset, liability to liability, and then you leave equity first. So let's go. Before we even do any workings, this is the first thing first to do. In this question, we have property, plant, and equipment. Akpaba has 640, Natasha has 125. Write it there. PPE. You open the bracket. You are not going to close it. I say Akpaba has what? Answer me.
640.
640. Then Natasha has what?
640, 125.
Thank you. Plus 125. Because of space, I will be writing it. So you leave it like this. You go to the second one. What is the second one? Basic investment in S. This one, you must always in it off. You must always ignore it. Basic investment in S, in N. Sorry, this is not S, it's in N. That is parent investment in N, that is Akpaba investment in N is 120. Now, if you check this question, they did not tell us how much was paid to get Natasha. Is that not so? Once they did not tell you how much it was paid to acquire it, just use this investment in subsidiary. You always see, just use it as your purchase consideration. Please take note of that. Well, I may forget that. I remember now. I may forget maybe when. That's why I quickly bring it up and I let you know that. So that is that for that. Now, under the non-current asset, there are no other items. The next item that we have is the current asset. Under the current asset, we have Akpaba has 140. Natasha has 20. You come here. Under here, you have current assets. Let me just use CA so that you know what CA is. CA means current asset. So you open bracket again. You will not close it. Current asset. How much is it? 120K plus 20K. You leave it like that.
Okay.
You leave it like that. Then next one will be equity and liability.
Equity shares.
The current asset of Akpaba is 140.
Come again.
The current asset of Akpaba is 140 and not 120.
Okay. 140. Thank you. 140. Thank you. Then we come to equity and liability. I said once you get under equity and liability, the only thing you carry under equity is the share of the share capital. Huh? The share capital. This one you can carry it and go and put it under the zero. It's not always there's no adjustment that will come to that one. So we have it there. Let's go. Equity share capital of parent is how much? 200.
200.
Yes. You bring it directly here, 200. That one does not have any workings. Then you leave space for NCI. You leave space for group reserve. You can even write it NCI so you will not forget. Then group reserve. Now, even you can even put the workings under this one because you know that it will be your working cease. Put it there, working cease. Then your NCI is workings what? Who can remind me? Who can tell me? Workings 5. Then parents also have a share premium, I guess so. If I'm not mistaken, I think I saw something like that. Parent also have a share premium. So you carry it, share premium of parent. You can take it directly.
Hello, sir.
I can hear you, please.
How do we treat our goodwill if there is a goodwill, for that accounting year?
We are going
Where
there.
do we... Okay.
Goodwill. Thank you so much.
Because
goodwill.
Because like you mentioned NCI, so if there's a goodwill, where do we put goodwill in this account now?
So you leave space. If there's goodwill now, usually your goodwill will come to your under your asset here. No, this one is asset, right? So you have PPE, you can leave space for goodwill. Just put it here, goodwill. If you are sure of your workings, that your workings will be there, you also put it there, workings 4. Have you seen it?
Yes.
Workings 4. But always note, it's only when there are goodwill that you bring your goodwill to this place. So you can see, we have been able to open bracket. So you bring your liability here. The next thing is liability.
Sorry, sir, you haven't put the share premium figure.
Sorry. Okay. What is the share premium figure, please? Share premium figure. That's 250.
250,000.
Yes.
250 and
4.
4.
Yes. That is it. Then liability. You only have current liability. You open bracket. That's 125. Put it there. 100K plus 25. You see? Usually there are no adjustments. From when you check the question, you know there will be no adjustment. You can even close this one. 125. Bring it here. 125. It's as simple as this. As it were, you have been able to open the bracket. I tell you, if this is the only thing you are able to do in your exam, there is no way you will not get 3 marks. And you are looking for 47 to pass. That's why I always advise students to do what? Open the bracket. Open the skeleton. Sorry. Do you understand it now? Open your skeleton always. Then from here you can proceed to your workings. Is that not so? So we are done with step 1. We are now in step 2. Any question? Any question, please?
There is no, sir.
Okay, so let's go ahead. What is the step 2? What do we do in step 2?
The first one is to determine the number of years to consider for consolidation.
Thank you so much. Determination of consolidation. And I always tell you that the first year that you will put date of acquisition is what we will put down first. What is the date of acquisition?
January 1st, 2021.
2021. Thank you. That's the date of acquisition. Then the date of consolidation.
31st December 2024.
31/12/2024. How many years is this now?
4 years.
Somebody said 4 years. Is it correct?
Three years.
Somebody said 3 years. Is it correct?
Yes, sir.
It's 4 years.
Olamilokun, you said 3 years. How?
Oh, sorry. 4 years, sir. 4 years.
Please, you are permitted to use your hand to count. You are permitted to use your hand to count. Look at it now. Date of acquisition is 1st of January 2021, meaning the whole of 2021 is full. Is that not so? So you have 2021, 2022, 2023, and 2024. So that makes it how many years? 4 years. So we are considering 4 years in our consolidation. Years is 4. That's workings 1. Workings 2. What do we do?
Determine group structure.
Determination of the
Group
group
structure.
And this one, I've always told you, you must always draw your arrow. Very, very important. You have to always draw your arrow. Very, very important to draw your arrows. So what is this? Is the group, the subsidiary, or let's just say group. Not the group. You have the parent. That's parent is who? Akbaba.
Baba.
Akbaba. Wisdom is profitable to direct. Well, not come find me for my house. Sub is Natasha. At least nobody go say I use the name now. Okay. Sorry, please. 1 minute. Now, how do I define? No, I don't see how to. Okay. Please, you must always draw these things. Very, very important. What is the percentage? 80%. You must write it like this. Then here you now put, under the subsidiary, you will now put NCI, non-controlling interest, 20%. You have determined the group structure. If you're able to determine this group structure, you have one at least half mark. That is workings 2. Workings 3 is what?
Fair value of net asset of a non-controlling interest.
Determination of fair value of NCI. Open bracket, come down to the next line, put it like this, at acquisition, at consolidation, and at consolidation, come down, put I hope it's entering, please. Any question? I hope you are getting it. It's very, very important. I hope you are getting
Yes,
it.
sir.
Any
Yes,
question?
sir.
Okay. This is how to do it at consolidation. So from here, you start. The first thing that you are going to bring is the share capital. What's the share capital of the subsidiary? You have 80.
Look, I think the time is about to enter.
I'm saying it. I just want us to quickly do this working study
Okay.
Yes, I want us to do this work in theory. Then we proceed. So share capital you have as acquisition is how much? You did not snap the question. At acquisition, share capital is what? 80. Share premium is 40. Please take note of that. And like I've always, like I've told you earlier, share capital don't change. Whatever you open with is what you should close with, except if there are issues or bonuses during the year. So, at acquisition and consolidation, usually are always the same thing. Is that taken? So that is that. Then you have share premium. Share premium, we're told is 40,000. So there are no share premium also will never usually do not change except there are bonus issues. 40,000. Then the next thing that will come here is what we call the retained earnings. Retained earnings. Now let's go back to the question. Retained earnings are always stated in your question at the beginning or your additional information. Please take note of that. Usually, the retained earnings at acquisition are stated, at the beginning of your question or in additional information, usually. Akpaba Limited acquired 2% of National Limited on 1st January when its net assets and retained earnings were 200M and 300M respectively. The fair value of 20% NCI was 12.5. Therefore, the opening or the retained earning at the date of acquisition is how much, please? Who can tell me? Are we together? Are we together?
Yes.
What
Sir.
is it? What is it? Please tell me.
It's 300 at
300.
acquisition.
Thank you so much. Acquisition is 300. At reporting date is how much? Okay. At reporting date, that will be at reporting date. Let's check it. Okay. I think there's this question do not have closing retained earning or reporting date for the subsidiary, as it were. So therefore, retained earning here will be 0. Means that this company actually is making loss. There are no other adjustments, as it were. So if we close it, it means we are going to have, sorry please, This is 80, that's 120. This will be 420. This will be 420. And there, this one will be 120,000. So meaning that no matter how we look at it, these guys actually made a loss. So in our next video, we'll continue with the the NCI, the goodwill, the NCI, and then the group structure and other adjustment as it were. Thank you so much one more time. Please feel free to ask questions and send us mail and we'll respond accordingly. Thank you so much one more time for your time.